Good morning, everyone. My name is Andrew Rasnick. I am an Associate Wealth Management Advisor with Northwestern Mutual, Series 7 licensed. I'm here today to talk to you guys about the idea of replacing the mutual funds that we hold in our portfolios for our clients with exchange-traded funds. We can now finally evolve out of the way our grandparents invested. So here's the interesting thing. I'm sure you all remember exactly what a mutual fund is, right? It's a lot of shares of a lot of different companies held in one wrapper. It trades at the beginning and end of each day, kind of, right? We have the forward pricing, market closes, they have to figure out what the price is next. Then when the market opens, you can get that price when you buy or sell. But we also remember the cool, clean, sleek stock, right? One share of a stock right here trades during the day while the market's open, instant pricing, live like that. When the market's closed, everything's done. You can't get it again or sell it until the market reopens. The great thing is in the 90s, they found a way to take this clunky, inefficient, heavy-duty mutual fund with all of its great diversity, and they got it to trade like this stock. So now we have a product that has the best attributes of a mutual fund, which is its diversity of holdings within companies, but we have it to where now it can trade as a stock. The other great thing now with the exchange-traded funds is that they're open in all 9 asset classes. This now gives our investors who maybe don't have the capital to get into certain types of private equity or things like that, they now have avenues to get in there at much less money. This then also ups the diversity of their portfolio, which we know in managing money, diversity in a portfolio is what's going to smooth out the bumps over the long term and give us the best results. With all that said, there's a couple other points that I want to draw your attention to. There was a study done by Villanova and UPenn where they determined that the after-tax efficiency of an ETF on average is 0.92%. We're almost at 1%. That is a huge cost savings to our clients when you look at the total volume that it would save them within their portfolio. And as acting as fiduciaries, we always need to have their best interest at heart. So if we can get the same performance, but with a greater tax savings, with that ETF, then we need to heavily consider that. Another thing to think about is how are we going to evaluate these ETFs versus the mutual funds? How are we going to evaluate ETF versus ETF? Now, I'm not a CFA. Some of you may not be CFAs, but we do need to understand how to evaluate one product versus the other. There's a great article out there with Fidelity and Investopedia that talks a little bit about this, and what they're saying is there's 2 great things that are easy and quick to look at that are going to give you a good idea of what kind of quality of thing you're looking at. One is how well does it track the index that it is following. Not all ETFs track an index, but this is an easy example. So S&P 500, how well does it perform compared to the actual S&P 500? We can compare mutual fund to ETF, ETF to ETF. Find the one that's closest. That's going to be your better bet. The next thing to consider is the internal pricing of things, okay? We have active, passive, this, that, and the other. And so what we just need to make sure we're doing is when we look at the internal expenses, we're comparing either 2 passively managed funds against each other or 2 actively managed funds against each other. We don't ever want to do apples versus oranges. Something else that I came across here recently that was really eye-opening and got me to buy even more into this idea of swapping out mutual funds for the ETFs is that 30% of the trading volume of securities in the US annually is ETFs. Now that's remarkable. These things haven't really been around in great numbers since the 90s. And to watch them take off in that short period of time compared to the lifespan of some other securities that have been out there, this is huge. This is showing us, this is proof of concept that there is something really to this and they need to be taken seriously. So with all that being said, I greatly encourage you guys to go out, pick your favorite mutual fund, find an ETF equivalent to it, start comparing, start doing your research, see how well they compare to the benchmark. Remember the tax efficiency of these things and that we are here at the end of the day to always act in the client's best interest. And I firmly believe that replacing replacing mutual funds with ETFs is your best bet 100% of the time. Thank you.